And so the risk is that if suddenly a lot of people want to redeem their stablecoins, will those reserves, will they have enough value to redeem all those? Will they even be liquid enough? Can the issuer sell those assets quickly enough at full value to redeem those stablecoins? And if the issuer can't do that, or if the reserves are at that point less than the value of the outstanding tokens, then you've got a real problem. And that can lead to a run.
Hi, everybody. This is How Tech Becomes Law, a public interest tech podcast about technology, public policy, and career advice. We are your co-hosts, Jingyan Zhang and Dhruv Gupta. This week, we have a conversation with Timothy Massad, former chair of the US Commodity Futures Trading Commission, about regulating stablecoins and cryptocurrencies.
Timothy Massad served as the chairman of the US Commodity Futures Trading Commission from 2014 to 2017. Under his leadership, the agency implemented many critical reforms to markets, including declaring cryptocurrencies to be commodities subject to the agency's jurisdiction. Previously, Professor Massad oversaw the Troubled Asset Relief Program, TARP, the principal U.S. government response to the 2008 financial crisis, in his capacity as the Assistant Secretary for Financial Stability of the U.S. Department of Treasury. Prior to his government service, Timothy Massad was a partner in the law firm of Kravitz, Swain, and Moore LLP. Timothy Massad is currently a research fellow at the Kennedy School of Government at Harvard and an adjunct professor of law at Georgetown Law. Hey, thanks so much for joining us, Tim, today. Just to get us started and get everyone up to speed, can you walk us through a little bit around what's going on in the crypto space? What is a cryptocurrency? What's a stable coin? There's a bunch of acronyms here like CDBC. Tell us more.
Sure. Well, first of all, Jen and Dhruv, thank you so much for inviting me. It's a pleasure to be here. So I would define a cryptocurrency as a digital token, a digital representation of value, if you will, that can be transferred in an encrypted way without a risk of double payment, meaning if I transfer it to you, then I can't transfer it to somebody else, and that is recorded on a distributed ledger so everyone can see it. A stablecoin is a type of cryptocurrency, and a stablecoin is a cryptocurrency that has its value pegged to something else, typically a sovereign currency like the US dollar or the euro. It could also be pegged to gold or something like that. And finally, a central bank digital currency would be a digital version of the US dollar. In other words, a digital token that is the US dollar.
Thank you. I think it's really interesting that for your career, that it's not necessarily that you started out in crypto regulation, but in a related space in terms of financial regulations, first as an attorney and then as a regulator with the Treasury Department, and then also with the Commodity Futures Trading Commission as the chair. How have these experiences shaped your perspective on regulating cryptocurrencies and the value of financial regulations?
Sure. Well, if I had started my career on crypto regulation, I'd be a lot younger, for one thing. But I would answer it this way. I would say, first of all, the financial sector, the financial industry innovates constantly. So there's always new things being developed, and they're often on the outskirts of the regulatory perimeter. When I started my career as a lawyer, interest rate swaps were being developed. And I spent a lot of time helping write the initial master agreements, standardized contracts for interest rate swaps. That was one of the big projects I did as a very young lawyer. And I continued to be involved in swaps, which are a type of derivatives. And that, of course, when I ended up at the Commodity Futures Trading Commission, kind of came full circle because my job was in part to implement new regulations governing swaps. What I saw at the Treasury Department, of course, was the way that financial innovation can lead to excess. financial innovation is a great thing. We want it. We want to encourage it. But unless we have a proper regulatory framework, financial regulation can lead to excesses. It can lead to problems. It can result in investors or consumers losing money unfairly. It can result in financial instability. And that's clearly what we saw in the 2008 global financial crisis. So I brought all those experiences to the CFTC, and that's why we acted on cryptocurrencies as we saw that industry starting to develop. Now we can talk about exactly what was the meaning of what we did, but that's kind of how it informed my approach.
Gotcha. And that makes sense. Like, you're coming from a background of innovation and financial engineering. I'll be honest with you, I am not. And to me, a lot of this like hocus pocus around crypto feels like a scam. I just don't understand it. You've written a lot about the regulation that might be required for stablecoins, particularly this piece in Brookings. Can you speak to sort of the main points that you've been discussing?
Sure. And let me just say before I do that, that I think there is a lot of fraud. There are some scams taking place in the crypto industry more broadly. And I think I'm skeptical that a lot of what is going on will have value in the long run. But stablecoins, I think, are a little different. And that's because they are pegged to a fiat currency, a sovereign currency, again, whether that's the dollar, the UK pound, or whatever. But at the same time, there isn't a regulatory framework around these. So I think stablecoins today are used principally in the crypto industry. They're a way, they kind of grease the wheels of the crypto industry. They allow you to move value around from different crypto exchanges, and there are a number of crypto exchanges, as well as between different cryptocurrencies if you want to trade those things. But they have application, they have potential application that's much broader. You could just think of them as a really fast means of making payments. They're not used as that today, but they could be. And so my paper talks about that, talks about the lack of regulation, talks about the risks that they pose, and what type of regulation we need, and also how they could actually help in terms of access to financial services for people on the lower rungs of the income ladder.
So I think it's really interesting that there's these promises that stablecoins can offer, but at the same time, right, it's operating potentially in an industry, as you mentioned, that has been rife with fraud and scams. So do you see regulation as then a tool to help make sure those promises happen? But in a way, why support stablecoins as the way forward versus just let's make the current financial services sector work better?
Yep, excellent question. First of all, let me say, stablecoins, I think, can be a way to speed up payments, but there are other ways, as you've noted. And my view is we need to speed up payments. We need to increase access to financial services one way or another. I don't think stablecoins are the only way to do that. But I do think we need to tackle that goal. There are 25% of American households are either unbanked, meaning they don't have a bank account, or they're what we call underbanked, which means they have a bank account, but they also use non-bank services like check cashing services or payday lenders, which are very, very expensive. Now, they do that in part because our financial system is inefficient and our payment system is very slow and expensive. If you live paycheck to paycheck, you can't afford to wait 2, 3, 4 days often for your paycheck to clear. If you're someone with savings, you can. You don't really worry about it. But if you're living paycheck to paycheck, you might easily decide to take that paycheck to a check cashing service because you can get cash right away. So that's the problem. And, again, stablecoins might be one way to tackle that. Now, your question about crypto's promises, I agree with you. I think crypto generally has not lived up to the promises that it made. When Bitcoin was first launched, it was described as something which would democratize the financial system and create peer-to-peer payments and reduce our reliance on what they call large trusted intermediaries. In fact, it hasn't really done any of those things. It's not a payment system. It's really just a speculative investment for people who have the means to afford it and can withstand the risk. And it's actually created a whole new class of intermediaries, the crypto exchanges and other brokers and so forth, as opposed to eliminating intermediaries. Again, stablecoins, I think, are a little different because they are actually tied to something. And that's why my paper focuses on those, but also really focuses on the fact that we've got to have a strong regulatory framework in order to prevent the risks that they can otherwise cause.
Right. So on the topic of risk, and as you mentioned, there are actually new intermediaries that cryptocurrencies end up creating, and one of them being the protocol itself, right? And stablecoins sitting on distributed protocols, but ultimately a digital rails system that is currently unregulated. And so can you talk a little more about, well, especially someone who was in the White House and also working with the Treasury Department with the financial crisis, like what are the systemic risks that you see with this level of centralization that could be possibly created if stablecoins actually take off and they become successful and widely adopted?
Sure. So there are a few different kinds of risks, and I would say there's maybe 5 or 6 categories of risks, and I'll tick them off and then try to go through each of them, hopefully without too much length. One is what I call prudential risks. One is operational. One is the risk of illicit activity. And then there's investor protection risks, and then maybe interoperability risks. So what do I mean by this? Well, first of all, let's remember how they basically work. You've got some sort of entity which issues a digital token in return for taking in dollars. And then if you get that digital token, then you can go and trade it and use it in various ways. So the first risk is, well, what is that issuer doing with your money? How are your dollars then invested? And we call those dollars the reserves that the issuer takes in. And so the first big problem is there's no regulations on that. You know, with a money market fund, the money market fund can't advertise itself as having a cost of $1 unless it invests its reserves in particular kinds of assets, cash deposits, treasuries, very high grade commercial paper, essentially assets that have very, very little risk. Stablecoins don't face that kind of regulation. So we have stablecoin issuers who range. Some of them actually deposit the money in banks. Some of them invest in all sorts of things. And so the risk is that if suddenly a lot of people want to redeem their stablecoins, will those reserves, will they have enough value to redeem all those? Will they even be liquid enough? Can the issuer sell those assets quickly enough at full value to redeem those stablecoins? And if the issuer can't do that, or if the reserves are at that point less than the value of the outstanding tokens, then you've got a real problem. And that can lead to a run. And it's really just like a bank run. And it's frankly just like what we saw in the 2008 global financial crisis when we had runs on money market funds because of the same types of concerns. And a run on one of those stablecoins could easily lead to runs on other stablecoins because people get worried about the whole industry. Again, that's exactly what happened in the financial crisis with money market funds. So by prudential regulation, what I mean is we've got to have regulation on how those reserves are invested. Got to make sure they're invested in safe assets. Got to make sure that there's liquidity and that the stablecoin issuer is able to redeem the tokens. Now, you pointed out that these things run on these decentralized blockchains, and that's exactly right. And some of them run on multiple blockchains, different blockchains. So you've got operational risk as well. Those blockchains, they are based on software, and they're based on smart contracts, and all that software can have bugs in it, or they can be hacked. So you've got those types of operational problems. And if something goes down, that's a risk. And that can, of course, trigger these other kinds of risks. You've got what I call illicit activity risks, in that unless you have some sort of oversight, these stablecoins could be used to finance illicit activity, money laundering, supporting terrorism, supporting other kinds of black market activities. Now, we have some regulation over that, but that needs to be strengthened also. And then there's what I call investor protection or consumer protection, which is really just your rights as an owner. If you purchase one of these tokens, what are your rights? What are your rights to redeem it? What are your rights to information? How transparent is it all? Things like that. And finally, what I called interoperability is kind of a sort of a different type of issue, but what you want to think about is if we start to allow these stablecoins to grow, we want that to lead to something like we have today with the phone system or email, right? I can send you an email regardless of who your email provider is. It would be terrible if I had to have an account on Gmail and I had to have an account on Apple separately to send an email to someone with a Gmail account and someone with an Apple account. So with stablecoins, it's kind of the same issue. We want interoperability between stablecoins. We want portability of data. We want consumers to have rights to their data, those kinds of things. So those are all the risks, and from that flow all the types of regulation that we need.
With this additional oversight, I worry that one of the big values of crypto, or at least one of the big things that excites the crypto community, is that they can kind of shove it in the face of the Wall Street financial elites, that there's this decentralization, no one owns it, especially in the aftermath of the 2008 financial crisis, the Occupy movement and such. And even with what happened with GameStop and AMC at the beginning of the year, folks aren't a big fan of the hedge funds and the citadels and even the Federal Reserve and the government. Does this kind of regulation fly in the face of maybe the spirit of crypto?
Yeah. Well, first of all, let me say that having worked to deal with the financial crisis, to basically stabilize our financial system as a result of the financial crisis, I certainly agree that big banks and large institutional players caused us a lot of damage. Now, some of that damage was caused not so much by traditional banks, but by newcomers to the industry that had grown in size and that were engaged in activity, mortgage lending, derivatives, and so forth, that wasn't regulated. And I also agree that having a less concentrated financial system would be a good thing. But as I said earlier, in a lot of ways, the crypto community claims to be for all that, but they haven't really done that. I don't see that Bitcoin has done that at all. Sure, it may be very popular among people who don't like big banks, but it hasn't really democratized the financial system, in my mind, in any real meaningful way. Sure, you may have a lot of people maybe that didn't have investments before invest in it, but I'm very worried that they lose money because I think it is a very speculative, risky investment. I don't think regulation is at all inconsistent with to either democratize the financial system more or increase access. In fact, I think it's on the contrary. The regulation doesn't have to be favorable to the big banks. Now, there is a risk. I will grant you, there is a risk that regulation is favorable to the incumbents, and it is favorable to large centralized institutions. And we've seen that over and over. And I actually have that concern about the report that was just released. So I think we have to be very mindful of that. I still think that the principle that we need reasonable regulation so that an activity doesn't generate excessive risk or doesn't, cause damage to the financial system as a whole, that's a lesson we've learned over and over and over and over again. And so I think we need to be mindful of it here.
So you just brought up, I think, an interesting point about the new law around regulating cryptocurrencies and stablecoins, and the issue of how do we actually make sure that these supposed promises that can be offered isn't just window dressing, which is taking a word from the piece that you wrote in Brookings, which I really thought jumped out off the page. For you, what do these regulations look like with your knowledge, with your colleagues that are working in this space, in the White House and also out of government? do you think it's something that can be done by the White House on its own, or do you
Sure.
think it really requires Congress to take a more active role and actually pass new legislation in order to regulate this space?
Sure. Great question. Well, the report recommends that Congress enact new legislation, and I think that's a good recommendation. And the report, I think, overall is very good. It summarizes both the potential for stablecoins by noting that they can make payments faster and more efficient, but at the same time, all the risks that we've talked about, whether they're risks of a run, of lack of liquidity, of operational risks, and so forth. My concern with the main recommendation is that they call for stablecoin issuers to be limited to what we call insured depository institutions, or IDIs. And those are essentially banks that are already chartered as banks. And on the one hand, I understand why they said that, because there is a strong regulatory framework there that, and if we pulled stablecoins within that, then we would have good prudential regulation and we would have a regulatory setup, if you will, where we could make sure a lot of these risks were addressed. But the problem with it is that it doesn't bring about more competition to payments. And I think we do need that. I think one of the reasons we have a payment system that is slow, relatively slow by what's going on in other countries. Okay, it may seem fast to most of us. We've got our credit cards, we've got our mobile banking, we've got Venmo, Apple Pay, whatever. That's pretty fast. But in actuality, it's kind of slow relative to what other countries have, because they have what we call real-time payments. And that goes back to the point I was making earlier, that when you live paycheck to paycheck, you want that paycheck to clear immediately. You don't want to have to wait 3 days. So the problem, the limitation I have with the report, or the concern I have with the report, is it says we should limit stablecoin issuers to traditional banks. And I would have rather seen them make that broader, still require strong regulation, but basically say, yeah, we could have new entrants in this space, new competition for banks, as long as they do the following things. And we kind of know what those things are. We could spell them out. I'm hoping that still comes about when the process gets to Congress and this gets debated, because I think, again, the main thing we need to do is modernize the payment system, whether that's through stablecoins or some other method. And one way of doing that is to create more competition. Again, as long as it's properly regulated.
So on the point of competition, one proposal that we're seeing, especially in other markets abroad, is for central banks to get into the space, right? We have China as an example of creating the digital yuan as a central bank digital currency, or CDBC. So what are your thoughts around the Federal Reserve entering the market with their own digital dollar as a CDBC?
Yeah, well, I think this is very important and it's very exciting. And it's interesting what China has done. China is rolling out its CBDC now, and it sped up its efforts because of stablecoins, because it saw stablecoins on the horizon and was worried that there might be a stablecoin based on the US dollar that would, undermine currencies in other countries. The Fed, also, our own Federal Reserve, launched its own research into CBDCs because of stablecoins, as did a number of other central banks around the world. And that was really when Facebook made its proposal for something called Libra, which is now called DM, which was basically a stablecoin concept. That isn't even operational, but the proposal alone got a lot of attention. So anyway, I think CBDCs are potentially a great way to modernize the payment system. Again, it's one option. And I think what we really need to do is we need to invest a lot more time and energy into building the prototype of the CBDC that we would want to see in this country. The choices that we would want to make in the design of the CBDC are going to be different from China's, quite frankly. China is rolling out something that appears to give the Chinese government a lot of information about the transactions of its citizens. Most Americans would feel very uncomfortable with that. So we've got to figure out, is there a way to balance the reasonable expectations of privacy that people have with government's legitimate interests in being able to monitor transactions, for large transactions in particular, for illicit activity and prevent illicit activity? How do you do that with a digital token or a digital system where everything is recorded? We've got to balance how you create this system so that it might help advance financial inclusion, but still you may not want to eliminate the commercial banking system either. So you've got to balance those things. So there are a lot of design choices. CBDC can be built out in any number of ways. And I also think it will be very important, if we do go down this path, to make sure that we still have innovation happening in the private sector, from the private sector. The government is not great at innovating. The private sector is going to do that. So if we create a CBDC, we would still want a system where there's good incentives for people to innovate in the payment space. And again, that comes back to design. One way to think about a CBDC is not that it replaces all of our commercial banks, but rather that we create something which is a digital representation of the dollar. It's kind of like the core operating system of our money. And then we have private applications built on top of that. The difference between a CBDC and what we have today is, today my only claim on the Federal Reserve is a paper dollar bill. Right? That's the only way I have a claim. All my other electronic means of payment and so forth, whether it's mobile banking or Venmo or credit card or whatever, those are claims on private institutions, on private banks. Now, my deposits in a bank are insured up to the cap, but that's still a claim on a private bank. So a digital dollar would mean that we could each have a token that is actually a claim on the Fed. And it kind of gets a little bit ethereal or kind of hard to think about why would that make a difference. But the main thing is it would be a way to speed up payments and potentially make our system more inclusive. And so that's why I think, we should spend more time on the research and development, see what it would look like, see how it could be designed to balance our various competing objectives, and then figure out if that's the best thing to do.
Absolutely. Thank you so much for that context around all this crypto regulation and the background here. You've got a really in-depth knowledge and background here, not only on regulations around crypto, but also just oversight around automated trading, cybersecurity for financial markets. And this is what you were up to at the CFTC. Can you speak a little bit more about how you've put together a lot of this expertise personally to work on these issues? Because it seems like you're at the intersection of kind of everything: tech, finance, law. There's a lot of things going on. Where how have you built this up?
Just to add to that, if you can imagine a young law student in your class at Georgetown, for them looking at these opportunities in the future, how do they translate what they're learning in terms of the traditional law school education or legal training into working in these fundamentally intersectional policy areas?
Sure. Well, when I was in law school, I was interested in financial markets and business, but I also had a strong commitment to public service. I had worked for Ralph Nader for 3 years back when Ralph Nader wasn't doing things like running for president, which is what maybe people of your generation might associate him with. He was doing some good consumer advocacy things. But in law school, I wanted to learn about business and financial markets because I felt like a lot of people who worked on public interest issues didn't really understand those. But I wanted to learn those things so that then I could contribute to public policy in that area. So I went to a large corporate law firm, and frankly, I thought I would stay just a few years, but it was really fascinating, and I learned an enormous amount. And I also liked developing a marketable skill, and I liked participating in the private sector. There's, as I said before, there's a lot of innovation and a lot of creativity and a lot of people trying to do good things by financing businesses and financing innovation. So I gained a lot of financial market experience through that. I spent 25 years practicing law all over the world. I was stationed in Hong Kong for a while, London, as well as New York. And then the financial crisis happened, and I kind of realized that was my moment to go back to kind of my roots, if you will, and go into public service. And basically everything I had learned from 25 years of corporate and financial markets lawyer was put to use in the financial crisis, in understanding what was happening and figuring out what we needed to do about it. And then that experience at Treasury then also led to the CFTC. So what's my advice based on that? Well, I guess the main thing is try, as you come out of school, to work with really smart people where you will be challenged and learn a lot. And don't worry about trying to think of your career in a linear path. Opportunities will happen, and you just have to be prepared to decide, do I step up? Do I get on the bus, as one person once put it, when an opportunity comes by? But if you've always sought experiences where you're learning new things, you're working with really talented people, you're being challenged, you'll be in a good position to do that. So that's whatever it's worth, that's the advice I have.
This podcast is called How Tech Becomes Law. And so we always ask this question at the end. Given your experience, how have you seen a technology and its designs create new rules for how society operates?
Well, it's really fascinating when I think back over the arc of my career. Again, just thinking back to how interest rate swaps were a new thing when I first started and what all those led to, and then looking at developments like automated trading and how that's changed markets, and looking at what happened in the financial crisis, and looking at cryptocurrency. And it just, again, underscores the point that we have an incredibly dynamic private sector that's really capable of just driving a lot of innovation and coming up with a lot of great things. And that's all really good. But we do need to have a regulatory framework around it, and so that you hopefully maximize the benefits without creating too much risk. And so I just think that creates a lot of opportunities for people. And it really comes back to when you're coming out of school and thinking about this. I guess the thing I would always urge people to think about is look at the financial system. If you're interested in the financial system, think about it from the standpoint of, is it working for most people? Is it working for average people, for people who live paycheck to paycheck, trying to make ends meet? Is it working to create jobs and provide new opportunities? There is a lot that goes on that's kind of, just saving some big corporation or some big financial institution a couple of basis points on its investment. And I think, why am I doing this with my life? And that's a good question to ask yourself. That does contribute to efficiency, some of that stuff, but is that the place where you can really have the most impact on making sure the financial system really works for most people? And that was a question I kind of had to ask myself. And I certainly had moments in my career where I thought, why am I at this big law firm? I'm not doing anything valuable. And that's in part what ultimately led me to leave and go back into public service.
Hey, thank you so much for joining, Tim. And thank you for listening. I'm Dhruv Gupta with Jinyan Zhang, and this was How Tech Becomes Law.
Thanks for listening to How Tech Becomes Law. We are supported by the Public Interest Tech Lab. You can find us online at howtechbecomeslaw.org and on social media channels at Tech Becomes Law. The music for this podcast was produced by Clarence Yap. If you enjoyed this podcast, please leave us a review on your podcast platform of choice. It really helps other listeners discover us. Thanks again for listening, and come back next week for another conversation on How Tech Becomes Law.